Hey guys, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. And this is part of an ongoing series of videos where what we're doing is we're going over some of the recent Undervalued Dividend Growth Stock of the Week articles, and I'm picking out one of those particular articles and I'm highlighting that stock via a video. So I take the article, I kind of break everything down for you guys, show you where I came up with some of the numbers and the conclusion, and that way you can kind of follow along. So if you're either a novice investor or you're a very experienced investor, there's still value to be had from both the articles and the videos, because in the articles I'm basically every week, every Sunday, and you can find all these articles. If you're at Daily Trade Alert, you're under the Dividend Growth Investing heading there, and then you pull up the Undervalued Dividend Growth Stock of the Week tab. It'll show all of the articles that I've written since I started the series, which goes back to late 2014 with Baxter right here. So, and if you look through, you'll just see it's kind of a treasure trove of high quality dividend growth stock. High quality dividend growth stocks that when I wrote that article, I thought they were appealing long-term investment ideas. So not all of them will work out fabulously, but I think if you look at them, the majority of these stocks have done pretty well. The businesses have done pretty well, and the stocks have advanced based on not only the upside between the value, the intrinsic value of the stock at the time of the article, and the price, which is typically lower than what the value is, so that there's upside there where that price starts to catch up to value. And then in addition, the organic upside that exists as a business becomes worth more as it sells more products and or services and increases profit and so on and so forth. And then of course you get those growing dividends along the way, which is really the most important part of it. So these are all the articles I've written, and then like I said, we're at July 12th right now, so I'm basically looking at the articles I've already written for July, which includes CVS and Tractor Supply Company. But then I pick one of those companies to kind of highlight, go over, look at the article, break everything down for you guys and everything else. So I did pick CVS for this week's video, and when I start this article out, every article kind of starts with a big idea, as I call it. Kind of, why are we talking about this? Why are we talking about dividend growth investing? Why are we talking about investing? What makes this such an appealing investment strategy? Why should people be interested in it? What can it do for you in your life? And just some quick background on me. Dividend growth investing literally changed my life, and I've talked about this quite a bit in the past through both articles and through videos. But by living below my means and taking my excess capital, investing it in high quality businesses that pay and grow and pay increasing dividends over time, I've built up a substantial amount of passive income that basically covers my core personal expenses. So like rent and food and things like that. I can basically live life without going out and making money. And once you're kind of freed from that dynamic where you're usually exchanging time for money, you're able to then kind of align your pursuits and passions with how you spend your time. And when you can do that, you generally become a happier person. You add more value to your life and to the lives around you and to the world around you, and life just becomes a lot better. And it reminds me a little bit of one of my favorite scenes in movie history in the movie Forrest Gump, when Forrest Gump gets that check from Apple, which I think he calls a fruit company, because he doesn't know, but he gets that check from Apple, and it's a sizable check, and he says, he kind of talks about money, and he says, well, that's one less thing to worry about, right? So if you can check money off the list in terms of life concerns, things become a lot easier. So getting back to the article, I talk a little bit about why you should even be interested in investing, especially with dividend growth investing. And later we get into why CVS in particular looks like a pretty good stock at this current time. And one of the things I talk about in the article is, Warren Buffett, of course, is, I don't know of a more successful investor over the long haul than Warren Buffett. I don't think there is one, certainly not one that's built up that kind of fortune. And I think if you look at the record that he has in terms of his returns over the long haul, I don't think anybody beats him. And I talk about how he actually, and I don't know if a lot of people are aware of this. I think people within our niche, within the dividend growth investing community, are aware of this, but people outside that maybe aren't totally aware of that. But Warren Buffett actually, in the common stock portfolio for Berkshire Hathaway, a lot of the stocks that he actually invests in are dividend growth stocks. These are businesses that that pay increasing dividends. And if you go up to the Warren Buffett Tracker, which under Daily Trade Alert, if you click right here, the Buffett Tracker, this is his portfolio for Berkshire Hathaway. This is Berkshire Hathaway's common stock portfolio that, of course, Warren Buffett manages the lion's share of the assets. And if you look at what's been built up over time, you'll see a lot of high-quality dividend growth stocks. You'll see American Express, you see Apple up here, you see Coca-Cola, you see Costco in there, even General Electric, which is trying to come back around. IBM, Johnson & Johnson, Kraft Heinz, and especially when you look at some of the big positions. Apple's 18 billion, American Express is 12 billion. You look down here, 27 billion, Kraft Heinz. You see IBM at 9 billion. You go down to the bottom, Wells Fargo, 27 billion. These are all companies that have competitive advantages, that generally routinely increase their profit year after year after year for a very long time, because the products and or services that they provide are generally ubiquitous. I mean, I'm drinking a Pepsi right now, so I guess that doesn't necessarily prove my point about Coke. In the last video I was drinking Coke. I try to mix it up. I own shares in both Coke and Pepsi, so I don't necessarily feel like I'm tied to drinking just one particular soda brand. But the products that, say, a Coca-Cola or a Pepsi sells are generally ubiquitous. You go into a grocery store, you're going to see Tostitos, you're going to see Coke, you're going to see Doritos, things like that. So, and that's what he invested in. And so, when you think about investing in businesses like that, and you're investing almost alongside Warren Buffett, and you really are if you invest shares in the businesses that he's bought into. But if you're analogous to that, you start to feel pretty good about your chances over the long haul, because I mean he's done very well. So that's just something I wanted to quickly point out when I was talking about that in the article. So so I did pick CVS for this week's video, and that was the first Undervalued Dividend Growth Stock of the Week articles I wrote for July. Okay, and talking a little bit about CVS specifically, they're a humongous provider of pharmaceutical products in the United States. They own more than 9,700 locations across the U.S. They have a little bit of international exposure. They're a huge pharmacy benefit manager, PBM, and they have nearly 90 million PBM members. They're just huge. I mean, I live here in Sarasota, Southwest Florida, and you almost can't go more than a few miles without seeing a CVS, on one of the corners. And they're generally, CVS and really Walgreens, they operate a lot like McDonald's, in that they typically have very, very prime real estate. They're typically located on the corners of well-trafficked thoroughfares and things like that. So they're getting a lot of traffic coming through. And and again, we were talking about ubiquitous products just a moment ago. I mean, when you think about necessary and ubiquitous products, pharmaceutical products are pretty high up there, especially with the United States becoming, older, richer, and larger. There's more people becoming older and wealthier over time. And as people age and as they have more money, the demand for access to high quality healthcare products like pharmaceuticals, that demand just increases over time. So when you think about CVS's position within that industry, within that market, they're positioned very, very well. They've got huge scale, which works to a benefit and to a detriment. On the benefit side, the scale provides them all those locations and nearly 90 million PBM members and everything else. So that's the good side. The bad side, though, is that it's hard to really grow much, from a humongous, it's hard to move the dial when you're doing hundreds of billions of dollars in revenue. So that's the flip side of the coin. But nonetheless, when we think about CVS stock as a dividend growth stock, we want to think about its, what is the wherewithal for dividend growth moving forward? Where have they been, over the last 10 or 20 or 30 years? Is there that track record there where CVS appears to be, committed to paying a growing dividend? And what do we think that wherewithal will be going forward? So when we look at that, starting with their track record, CVS has increased their dividend for 14 consecutive years. And, as I talk about in all the articles, I use David Fish's Dividend Champions, Contenders, and Challengers list for that dividend information. He's just, he's fantastic at compiling this. He's got over 800 different U.S. listed stocks all with at least 5 consecutive years of dividend increases. So CVS, of course, is on there. But if you go through this list, you're going to see a ton of stocks, just like the ones I was actually just naming off with Warren Buffett there, IBM and Wells Fargo and Coca-Cola and American Express and all that good stuff. So CVS, of course, is on here, 14 consecutive years of dividend increases. And then we look at the dividend growth, which is over here. You see 10-year, 5-year, 3-year, 1 year. So when we look at their dividend growth, I mean, it's just massive, right? We've got 10-year 27%, 5-year 27.7, 3-year 23.6, 1 year 21.4. There's a slight deceleration there, but only because, I mean, you can't keep up 27% dividend growth forever. I mean, that's impossible. But even recent dividend increases, I mean, we're still talking well into the double digits, which is just massive. Of course, that's going to start to bump up against the payout ratio, which I talk a little bit about in the article. So I've got 14 consecutive years. We've got 10-year dividend growth rate. Of course, we just saw that 27%. And the payout ratio is 41.4% right now, which David Fish compiles that information for you right here. And you can also, I use Google Finance a lot for just a quick and dirty look at TTM EPS, which is right here, 482, trailing 12 months earnings per share. And then you got the dividend right there. So you got 2 divided by 4.82, gives you a payout ratio of 41.2%, 41.49. I could have rounded that up, 41.5, but you see right in there, 41.4%. And then the yield, which you can get right here. Again, I wrote this article a couple weeks ago. So the yield's naturally going to fluctuate as the price fluctuates. Yield and price are inversely correlated. So as the price of a stock falls, the yield, all else equal, will rise, and vice versa. So looking at when I wrote the article, the yield was 2.45. It's now 2.58. So the stock, obviously, with the yield being higher, that means the price has fallen just a little bit, which really just makes the stock a little more attractive than it was a couple weeks ago. So looking at that, we've got a yield of 2.45%. We got that payout ratio now bumping up at a little over 40%, which is going to limit that dividend growth a little bit going forward. I mean, even if CVS is growing their earnings per share at a very nice rate, let's say 8 to 10% or something in that range, with the payout ratio starting to creep up there a little bit, it's going to limit some of the dividend growth potential. And we see that deceleration start to kind of really pick up here. The most recent increase being a little under 18% compared to 27 on the 10-year. So, looking forward, I mean, I would not expect this kind of monstrous dividend growth to continue. But, if CVS continues to hand out, 10 to 12% dividend increases for at least the next few years, I mean, when you look at that in combination with the yield of 2.5%, that's pretty solid. Generally, assuming a static valuation, your total return is going to be the sum of the yield and the dividend growth. So when you look at dividend growth in the double digits and you're looking at a yield of 2.5%, that sets you up for some pretty nice return, and that sets you up also for a pretty appealing yield that's over the rate of the broader market, certainly well in advance, well in excess of what you're going to get at the bank. And then you're looking at income growth well in excess of inflation, well into the double digits. So, you almost can't help but get ahead here with the stock, unless something happens to the business model, something dramatic and fairly sudden. Outside that, it's pretty hard not to do pretty well with CVS going forward, because it's just setting you up. I mean, the expectations are pretty low, as we'll talk about with the valuation. You're getting a pretty appealing yield here of 2.5% plus, and then you're getting dividend growth well into the double digits. So that's setting you up for some pretty nice current income and some pretty nice income growth. So, and I talked a little bit about that right here. That current yield of over 2.5% compares pretty well to the 5-year average yield of 1.5%, which, if you go to Morningstar, and as I've talked about in prior videos, you click on the valuation tab right there, you see CVS's 5-year average at 1.5% right here, guys. So with the current yield being 2.5%, you're more than 100 basis points over that. That's really incredible. So what that's saying is that investors over the last 5 years, on average, have typically been willing to accept a yield of about 1.5% on the stock. So when investors have been buying CVS stock, they're saying, you know what, with the growth well into the double digits, I'm willing to accept a starting yield at 1.5% because I think that's a pretty appealing setup for the long haul. Well, now, buying the stock today, sets you up way further ahead because you're getting far more current income, full 100 basis points ahead, which is a full 100 basis points potential increase in your long-term total return compared to what it was before, just based on the yield alone is 100 basis points. And then in addition to that, any potential upside as the price catches up to the intrinsic value. So when you buy an undervalued stock, if a stock is worth 50 and you buy it at 40, you've got that $10 per share worth of upside, in addition to whatever organic upside that will occur as the business becomes worth more, as it sells more product and or services, and as the profit increases, so on and so forth. So that's what we're looking at here. So when you see a historical yield at X number and you see a current yield at X plus 100 basis points, that starts to kind of right away, it should start to kind of trigger some alarms and say, ding, 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 wait a minute, why is the yield currently so much higher than it's typically been? What's going on with the business? Did something happen? Is it just a valuation issue? Is something going on with the business, negatively that would affect the stock price that much? And we'll kind of get into that a little bit as we go on with the valuation. But, right away you can kind of see a pretty disparate difference in terms of current income and historical income on CVS stock. So the next thing we get into, in order to estimate, future dividend growth, which is really necessary when you start to value a business, you're kind of trying to estimate future growth, because any business is ultimately worth the sum of all cash flow it can provide from now until doomsday, discounted back to today, for net present value. So when estimating out future growth, you want to take a look at what the company's historically been able to do over the long haul. And again, as I've talked about before, I use 10 years as a proxy for the long haul. So you want to take a look at what a business has been able to do over the long haul, and then you look at a forecast for what we think, what an estimated guess might be for that growth going forward, at least over the next few years or so, because guessing growth out over 100 years is obviously almost impossible. So you're really just taking a look at what they've historically done, what we think a near-term number will be, and then you kind of conservatively combine those numbers and move that, start to kind of move that forward. So the first thing we look at is top-line growth, revenue growth. And anytime I'm looking at a pretty mature business in a pretty mature industry, I want to see mid-single-digit revenue growth if possible. Somewhere between 4 and 6% is generally what I look for. And we can already see here, if you look at the revenue here, CVS has grown its revenue at an almost 10% compound annual growth rate over the last 10 years. So I'm going from fiscal years 2007 and 2016, which is 10 fiscal years, and I'm basically taking the two numbers. And where I'm getting these numbers, of course, guys, if you go to CVS Investor Relations, their investor relations site, which is really neatly laid out and everything, kind of colorful, if you go over to the annual report archive, that'll pull up annual reports going back, well over 10 years. And so I basically pulled up the first one, which is 2007, and I'm getting the revenue, which is right here, 76,329. You see that right there, guys? You see here 76,330, just rounded up. And then you see the most recent fiscal year, which was 2016. Revenue is now 177.526 billion, and which is right here, guys, 177.526. This is the 2016 annual report, and I've got the consolidated statements of income already kind of pulled up for you. So those are the two numbers, and I basically just take them in a compound annual growth rate calculator, which I use Investopedia's, but you can use whatever compound annual growth rate calculator you'd like. I just use Investopedia's. It's pretty easy to use. So I'm basically taking that 76,330. Whoop. And I'm taking the most recent number, which is 177,526. And I'm looking at 9 compounding periods, because the first year, which is 2007, is not a compounding period, it's a starting point. Okay, so it gives me a compound annual growth rate of 9.83%, which is reflected right here in the article. And again, I mean, you can see what kind of base CVS is growing from here. They grew back in 2007 from a base of 76 billion. They're now working with a base of 177 billion. So these are huge numbers. So for them to grow their revenue top line at almost 10% annually is nothing short of just mightily impressive. That's just huge, very, very big. The problem is going to be that's only going to become harder as time goes on, because the number that they're growing from has more than doubled over the last 10 years. So, growing from a base of 177 billion is obviously more difficult than growing from a base of 76 billion. That said, there's really a lot of wiggle room in there, because if I would have done these calculations and this number would have been 5% or 6%, that's still a pretty solid number. I mean, if CVS drops that down a little bit, I wouldn't really be too concerned about that. I mean, 10% revenue growth, leaves you even more wiggle room for bottom line growth when you start to factor in potential margin expansion and share buybacks, so on and so forth there. So that's a really great number. There's really, I don't see how you could find any concerns with that or any complaints with that whatsoever. And then the next thing we want to take a look at is bottom line growth, which is earnings per share growth. And taking a look at that, we've got the number from the 2007 annual report at 192. This is diluted earnings per common share, net earnings 192. Okay, and you can see that pop up in the article right here, 192. And then the most recent number, which is diluted earnings per share attributable to CVS Health, which is 490 right here. And you see that pop up right here. So 192 to 490. We got 10.97%. So they grew their bottom line at a compound annual growth rate of just under 11%, which you're looking at a pretty nice spread there between top line and bottom line growth here. You see a nice little spread there of about 100 basis points, right? And that was really just due to share buybacks. If we kind of go back, you see the weighted average common shares outstanding right here, 1371. That's in millions, so it's 1.3 billion, right? And then we see here 1079. So they reduced their outstanding share count by about 300 million shares, almost exactly 300 million shares. So that's pretty significant. And I did the math for you already. That's a 21% reduction in the outstanding share count, which is really where you're getting this excess bottom line growth from. Going forward, they're going to have to continue buying back stock to really kind of keep that bottom line number, pretty hefty, because like I said, this number is almost certain to slow down a little bit. I really don't see them continuing to grow their top line at 10% annually indefinitely, or even I would be really shocked if the next 10 years shows that same number, 10%, going forward. But nonetheless, they can still keep this earnings per share growth rate at a pretty high number, probably up near that number going forward. And in these articles, that's what I do. I take a look at what we think a forecast will be going forward, at least over the next few years, because trying to forecast this out over 20 or 30 years is extremely difficult. And I use CFRA, which is formerly S&P Capital IQ, and when you pull up their report, they have a 3-year projected earnings per share compound annual growth rate right here, which is 10%. And you see our quality ranking at A+, which it doesn't get any better than that. And that's why I say I usually focus on high quality dividend growth stocks. And when we talk about quality, we're talking about fundamentals. We're talking about well capitalized businesses that are growing at a very good rate, that are paying and growing dividends, that are very profitable, that are leaders in their industry, so on and so forth. And S&P actually ranks that. They actually put a quantitative letter to it, and that's where you're getting that from, which is A+. So what CFRA believes CVS will do going forward, at least over the next 3 years, they believe that the company is going to continue growing its earnings per share at a 10% annual compounded rate, which is not really far off from what they've done over the last 10 years. So, if CVS is able to continue growing its bottom line, if they're able to continue compounding that out at 10%, when we look at that payout ratio at a little over 40%, like I said, that leaves plenty of room for double-digit dividend growth going forward, because there wouldn't even really be, if CVS grows their dividend at, say, 12% over the next 5 or 10 years, and earnings per share growth is almost keeping pace, that payout ratio will barely expand. So that leaves a very, very long runway for very, very attractive dividend growth, going out many, many, many years. So unless this forecast collapses, unless something really dramatically happens with the CVS, a negative event of some kind, even if earnings per share growth doesn't come in at 10, even if it's 8 or 9, again, double-digit dividend growth can continue for many, many years just based on where they're already sitting at. Okay, so the wherewithal is definitely there. We can see that. Earnings per share growth, double digits, dividend growth, double digits, payout ratio a little over 40%. And like I said before, I consider a perfect, I'll call perfect payout ratio. I consider one that's perfect is 50%. And that's because a business is retaining half its profit to continue growing for M&A, to be flexible with the balance sheet, maybe pay down debt, building out, let's say, new stores or what have you. And then the other half of earnings is going back to shareholders in the form of a dividend, which does two things. Well, it does many things, but two primary things. Number one, it limits how much wiggle room management has to kind of screw up the capital allocation plan. Because, if somebody were to give you $100,000 a year to spend, you might be a little frivolous, but if somebody cuts that in half and says, okay, now you only have $50,000 to spend, you're going to be a little bit more choosy with how you allocate your capital, right? Well, it's the same thing with companies, okay? So if half that money is going to shareholders, that really limits management to their best opportunities for that capital allocation. And the other thing it does is it allows shareholders to invest that capital at a rate that they think is going to be even more attractive than what it would have otherwise been, especially had it been wasted. And of course, for me, as a dividend growth investor who has been seeking out financial freedom since early 2010, we're going on more than 7 years into my journey here with this. It's passive income, and it's growing passive income, and it's growing faster than the rate of inflation, which increases my purchasing power. So for me, it's a win-win-win-win-win-win-win. I mean, there's almost no losing to it. People can maybe point to taxes and things like that, but there's very few drawbacks to that kind of dynamic and that kind of relationship. Okay, so that's what we're looking at. We're looking at basically the earnings power of CVS being somewhere near low double digits. We're looking at somewhere around 10%. They've grown already at 11%. We think they're going to continue growing at a rate of 10%. They have demographic trends that bode well for the company. So that's something that when we look at that and we look at that low payout ratio, I think dividend growth, low double digit dividend growth, 12 to 14% over the near term would not be a difficult hurdle for the company at all. I do talk a little bit about some drawbacks to the business, some headwinds. The shift to e-commerce, I mentioned that in the article. That's a problem, and I want to kind of address that real quick. When people talk about e-commerce, I think at least just some of the things I've kind of come across when looking at some of these pharmacies, a lot of the concerns have been kind of relating to branded and generic drugs going online and then just being bought online and delivered directly to customers and everything else. Well, the major pharmacies already have a business in that, and there's actually a CVS across the street from my apartment, and they deliver locally. So there's that shift has already started to occur, and these businesses still continue to grow at a very attractive rate. I mean, you can see I'm at the most recent annual report here, and you see revenue right here. 139.3, 153.2, 177.5. I mean, CVS continues to grow even as the winds in the industry are shifting. But one thing I don't think a lot of people have really addressed, and which I personally think is a bigger concern and something to really keep an eye on. Let me go back up to the segment breakdown here in the most recent annual report here. Here we go. So CVS breaks down their segments, which they have the pharmacy services segment, the retail LTC segment, the corporate segment, and then inter-segment eliminations, which is like things that overlap between the pharmacy and the retail, okay? And then they break that down into the consolidated totals over here at 177,526, which is for the most recent fiscal year revenue. And when you see how the segments break down, guys, you see the pharmacy services segment is the biggest one at almost 120 billion, and then you see retail LTC at 81.1. So CVS is primarily a pharmacy, and they are, most of the sales are coming about via the pharmaceutical business, okay? However, a very, very significant portion of their revenue, and of course their profit and everything else, which they break down, down here a little bit. The retail LTC segment, you can see 81.1 billion of their revenue comes about via the retail side. And then you can see the gross profit right here, right? So you see it's an even bigger portion of their operating profit than the pharmacy segment. So when I think about CVS, when I personally think about CVS, I think of them less as just a straight shot pharmacy, as someone really concerned about, drugs being sold online and kind of the rise of e-commerce, the real big problem for CVS would be that as sales move online and as e-commerce becomes a bigger segment of the overall retail economy, they're going to naturally lose out on some of these retail sales, because when people go into a pharmacy and they're buying their drugs or they're getting what have you, and they're going in, they're picking up some retail stuff as well. That's a major part of what CVS does. I mean, you can see that right here and how it breaks down. So if somebody stops going to CVS and stops going to Walgreens, and these pharmacies basically just start to lose a massive amount of business, the pharmacy services segment does get impacted. But the bigger concern for me personally as a shareholder, as an investor, and becomes this side of things, because if you're not buying that candy bar and you're not buying the razors and the shampoo and everything else, that's what all this is. That said, when we look at prior years, you see 2014, 2015, you can see the retail LTC segment. You can see that it's really growing strongly, even as retail in general, especially general merchandisers, as that has moved online and as e-commerce has taken up a bigger and bigger chunk of the industry, CVS is still growing their retail side strongly, robustly here, right? So they've proven kind of, I don't want to say invulnerable, but they've certainly proven resilient when it comes to the changes in retail in general because of the pharmacy segment, okay? But if there are any cracks here, that will naturally affect this. So these two segments work together. They're inextricably intertwined with one another. As pharmacy goes, the retail goes. Okay, so if pharmacy starts to really move online, then that will naturally affect the retail side, and that's something that I am a little concerned about, and I talk a little bit about that in the article. But let me go back down to the financial statements here. Okay, so that's just something I want to talk about real quick, and I talk a little bit about that right here. Continued shift to e-commerce is a long-term headwind. And I talk about that CVS has a presence there, but more sales online mean less retail sales in stores, and that's really the bottom line. And 40% of the revenue of the overall company sales comes from the retail LTC segment, okay? So just something to kind of keep an eye on. And then when I move on in the article, I talk a little bit about the other fundamentals for the business. The first thing that I bring up after the growth of the company is the balance sheet. And I look at two basic numbers, the long-term debt-to-equity ratio and the interest coverage ratio. And where I'm getting these numbers, again, back to the most recent annual report, 2016, the long-term debt-to-equity ratio, again, let me just a sec here. I've talked a little bit about the long-term debt-to-equity ratio being a bellwether figure that is commonly used in the investment community. I see professional analysts use it all the time. It's a very common metric that you can pull up. Even when you pull up Google Finance, I have some other columns added, but you see long-term debt-to-equity ratio right there, okay? It's a common number to use. I don't really place a lot of value on it because, as I've talked about before, shareholder equity can be positively or negatively affected quite a bit, which throws off the number. But nonetheless, if you're comparing it within the industry and you're comparing it within the historical context of the business, there's some value there. And generally speaking, a number below 1 is good, and a number above 1 is not so good. And that also depends. Nothing operates in a vacuum. Balance sheets and businesses don't operate in a vacuum. So it depends on how capital intensive a business is. The more capital intensive it is, then naturally the higher that long-term debt to equity ratio is probably going to be. CVS is somewhere in the middle there in my view, and their long-term debt to equity ratio kind of reflects that. So to get the number, we basically just take long-term debt and divide it by shareholder equity, okay? So long-term debt, we can see right here, $25.6 billion. So we take that number and divide it by shareholder equity, which is right here, total CVS Health shareholders equity, 36,830. We get a long-term debt to equity ratio of, rounded up, 0.7. And I reflect that right here, 0.7, just rounded up. So again, that's a pretty good number. The more important number though that I like to look at when I look at balance sheet, when I look at financial flexibility, when I look at a company's ability to cover its debt and still run the business well, is the interest coverage ratio, which is basically how much of its EBIT has to cover the interest expense. You know, what percentage of EBIT covers interest expense? And EBIT, of course, is earnings before interest expenses and taxes. And to get that number, we basically go back up to the income statement here, and we look at income before taxes, which is 8637, so just a little over 8.6 billion, okay? And then we add in that interest expense, which is right here at 1058. So we've got EBIT of just under 10 billion, okay? 9.695 billion. And then we divide that by the interest expense. So it tells us, so we got an interest coverage ratio of just over 9. So their EBIT covers interest expenses 9 times over, which is again a pretty good number, as I've talked about before. You know, when you start to get in the low single digits, you know, 1, 2, 3, 4, you know, a coverage ratio, interest coverage ratio of, you know, 1 or 2 or 3 or 4, that's not real good. Anything really under a 5, I start to become kind of concerned about. Anything above 5 is generally pretty good. And then once you get into the double digits, you know, 10 and up, you know, you're looking pretty healthy. And CVS is right in that range. It's the balance sheet's okay. It's not, they don't appear to be overly leveraged, in my opinion. And just to kind of get a quick and dirty comparison, you know, their largest, you know, competitor obviously is Walgreens. And you see the long-term debt to equity ratio right here. You know, they're right in line there with the industry. You can kind of see some of the ROE and net profit margins, the profitability metrics we'll get into in a minute. They're right in line with the industry. So it's an okay balance sheet. It's right in line with the industry. Not particularly excellent, and certainly nothing to be concerned about. So they kind of pass with that. The next thing we look at in the articles, of course, is profitability, which is net margin and return on equity. And again here, return on equity, ROE, is another kind of bellwether metric that people use for profitability. I personally do not place a lot of importance on it, again, because of that equity part of that equation. You know, shareholder equity, it goes into that because you're basically taking a look at shareholder equity is essentially the net worth of a business, right? And when you're taking a look at return on equity, you're taking a look at, you know, net income against shareholder equity. And with shareholder equity being a number that, you know, the more and more I've looked at businesses, the more I see that, you know, for instance, treasury stock, companies that buy back a lot of stock and keep it in treasury stock, that negatively affects shareholder equity. So that will naturally affect ROE and the debt to equity ratio. So I don't really consider it a great number. I mean, it'd be like kind of taking a look at you know, if in your personal situation, you know, you call yourself your own CEO or your own CFO you know, I could call myself the CFO of Jason Inc. and take a look at my own numbers. Return on equity would essentially be looking at what's my, you know, net income divided by my net worth. And, you know, I don't really find a lot of value in that. Net margin, though, is extremely important because that tells you, you know, what percentage of revenue drops down to the bottom line in terms of profit. So, you know, obviously all else equal, you know, you'd rather squeeze a dime out of a dollar than a penny, you know. So the higher the net margin, the better, all else equal. Of course, you know, again, these businesses don't operate within a vacuum. So the net margin of a retailer, which CVS essentially is a retailer. I mean, we just kind of looked at that earlier. The net margin of a retailer is going to be very, very different from the net margin of a bank or a financial services company or a consumer products company or a heavy machinery company. So all that stuff needs to be kind of taken a look at, you know, within context. And I basically look at what they've done over the last 5 years, and to get that number, again, I pull up CFRA. Whoop, that's Morningstar. And the CFRA report tracks that right here. So you've got the annual averages, you got the key growth rates and averages. You look at 5 years, net margin 3.3%, and return on equity 12.55%. You see 3.3 and 12.55. So those numbers, that's where I got those numbers from. And just kind of to get an idea of whether you know, margin is expanding or compressing, when you go back to Morningstar here, and as I've talked about before, you obviously want to go right to a company's investor relations site, pull up the actual financial statements, pull up the annual reports, pull up the 10Ks and the 10Qs and everything else, and delve into the real numbers, because these you know, the companies that aggregate data like Morningstar, they're generally pretty accurate, and you can see right here, revenue, earnings per share, it's all accurate. Shares outstanding, where's that? Shares, 1371 to 1079. All these numbers are accurate. but sometimes they're missing, sometimes they're not accurate. You've got to kind of go right to the source when you start looking at some of this stuff. So, in order to get a quick idea of whether margins expanding and compressing, or is it pretty static, you can look right here. Morningstar actually computes that going back over 10 years, and you can see that it's been pretty static. This most recent year was a little bit of a compression, but generally somewhere in the threes. They're pretty consistent. Return on equity, same kind of thing. So it's been pretty consistent profitability, which again earlier is why I said that the excess bottom line growth, which really wasn't that much, was mostly driven by the share buybacks. Sometimes you'll see a margin expansion, and that'll obviously fuel bottom line excess growth because you're getting more profit dropping down from revenue. In this case, really didn't see that too much. If anything, you might say there's maybe a slight compression there, but I'd really hesitate to even kind of go that far with it. Nonetheless, if we see the 5-year average is 3.3%, most recent years 3, something to kind of keep an eye on. And if you want to calculate that yourself, you go back up to the most recent, let's see, the income statement right here, 2017 annual report. You basically just take a look at the net income, which is right here, 5319. Divide that by the revenue. So 2.996. So it's 3. So Morningstar again is pretty accurate. They've got it at 3. It's 3 rounded up. So it's okay. And then when we look at it within the industry itself, if you pull up Walgreens here, just kind of a quick look, they're at 3.5. Return on equity, they're pretty competitive. Again, the long-term debt to equity ratio right there. The average is 3.3 over the last 5 years. Walgreens coming in at 3.5. It's pretty similar. It's not something where Walgreens is beaten them by by 100 basis points or something like that. They're right in the same neighborhood. So not something I'd be too concerned about. It's pretty good profitability for the industry, for a retailer in general. 3%, low single digits. So pretty solid stuff. And then obviously we talk about the valuation. So getting into that, we can see the PE ratio was at 16.57 when I wrote the article. It's currently sitting at 16.07. So the stock has been it's come down just a tiny bit. It's almost the same. But when we compare that PE ratio of a little over 16 to the 5-year average, which again is that valuation tab on Morningstar, you see the 5-year average is 20, which is why that investors have typically been willing to accept a lower yield, is because they've been willing to pay a higher valuation, a higher multiple of earnings for the stock. So that's a pretty significant drop from where it's typically been. It's been somewhere around market average, we'll call it, and it's significantly below now. And that's what increased that yield. The yield was partly increased by the valuation compression, as well as the fact that the dividend growth has been expanding. The payout ratio has been in excess of earnings per share growth, which naturally kind of starts to float that yield up a little bit, especially when the valuation doesn't keep up. And here, not only did it not keep up, it fell. So investors are paying a much lower multiple for earnings than they've typically been willing to pay over the last 5 years, as you can see here. Cash flow, same thing. And this is a 3-year average on cash flow, but 14 times cash flow, you're now paying 7.4 times cash flow. So not just earnings, but actual pure cash flow. Investors are paying, we're talking almost half here, which is substantial. And again, that's why you see that big difference in the yield and everything else. So just based on that kind of quick look at things, saying, okay, yield is 100 basis points higher, PE ratio is much, much lower than it's historically been. There's been no significant adjustment to earnings. This is a pretty accurate number when we're looking at a little over 16. So if this number were like, an 8 or something, you might say, whoa, what's going on here? And look at some adjustments. But, I ran through the numbers, and CVS didn't really have anything significant which would, affect earnings per share that much. So that's a pretty good look at and again, the numbers that I pulled up in the article and the numbers I use in the annual reports are GAAP numbers. So those are GAAP numbers. It's not adjusted numbers or anything else. I'm not trying to, kind of massage anything or anything. These are real numbers, and you just see a difference there. Investors are just paying less for the stock than they've been willing to pay on average over the last 5 years. So that sets you up very nicely again for that upside as we talked about earlier. And getting back to the article, I also did the dividend discount model analysis. And with this one, I did a one-stage dividend discount model analysis. I did a 10% discount rate, which I've talked about in prior videos. I use that on most stocks, which is just a little bit higher than what the stock market's provided for over the long haul, which kind of builds in a little bit of a conservative factor in the dividend discount model analysis. And then I used a long-term dividend growth rate of 7.75%, which is actually a little lower than the last time I looked at CVS. I think the last time I looked at it, I built in and I modeled in 8% dividend growth long term. And I just kind of backed that up just slightly because the last time I looked at the business, it did look just a little better. There were just some numbers. The growth rate was a little better. The balance sheet was just a little better. So there's just been a slight deterioration in CVS. Will that continue for the long haul? I don't think so. But I did want to kind of reflect that a little bit in the model. So I've got a long-term dividend growth rate of 7.75%. So if we kind of look at that, we got the dividend at $2. We got 7.75%. This is a long-term one stage. Then I got a 10% discount rate, right? Whoop! Did I do something wrong here? Sorry, I wanted to pause it. I missed a 7.75% on the bottom. I usually actually use a spreadsheet, guys. I talked about that in prior videos. So I just pull this up for the videos because it's an online from moneychimp.com. It's an online. It's actually a discounted cash flow calculator, but you can use it as a dividend discount model. It does the same thing basically. So I just forgot to put in the number there. So that gives me the fair value of 95.78. Which I reflected right here. You see that fair value 95.78, and the stock is at 77.45. So when you look at where the yield is, the price to earnings ratio, price to cash flow, even price to sales, price to revenue, everything indicates that the stock has typically gone for a much higher valuation than it is going right now. Yet the business hasn't really deteriorated that much. And we can kind of start to see if we pull this stock chart out a little bit. You can see over the last year, the stock's down 20%. But the business definitely has not deteriorated 20%. I mean, again, I backed that long-term dividend growth rate. I kind of dialed that back just slightly. But I mean, we're talking 20% here on the stock price. So we're looking at about 100 a share. It's now 77. CVS has definitely not deteriorated as a business by 20%. And really, even at almost 100 a share, it was still trading at below, at levels below its recent historical averages. So it's gone from kind of a little below that to well below that as the stock price has declined significantly. Which I believe, CVS, if I were to make a call on it, I mean, CVS I think is just getting caught up in the general, concern over where are some of these retail businesses, which CVS is largely a retail company, where are these companies going to be 10 or 20 or 30 years from now as most of these sales start to move online? So, the stock deserves some fear regarding that, and perhaps this historical valuation of 20 times earnings, that needs to maybe come back a little bit. Maybe investors were just paying a little too much before. So maybe things are, maybe investors are correcting a previously incorrect estimate of intrinsic value. That's certainly possible, but boy, I mean, if you're saying that it was worth this just a few years ago and now it's worth this, I mean, that's a significant correction coming back, and I just don't see anything in the numbers that would indicate that that's valid. It just doesn't seem quite right. So nonetheless, the dividend discount model analysis that I used, if you look at that, again, as we talked about earlier, CVS has been growing at 11% annually over the last 10 years, the bottom line. The bottom line is expected to grow at 10% annually. This is compounded annually over the next 3 years. The demonstrated dividend growth rate over the last 10 years is well over 20%. The most recent dividend increase was well into the double digits. So, I mean, I'm being very, very conservative here with this 7.75% long-term dividend growth rate. Because what I'm assuming is that CVS is going to grow the dividend, into the low double digits. I would expect 10 to 12, maybe 13, 14% dividend growth for the next few years, slowly dropping that down to probably closer to 10%, and then flattening out, into that kind of mid to high single digit rate looking out over many years, which, I'm just averaging it out right here. So nonetheless, I mean, looking over, definitely over the near term, I think that's being pretty conservative with it. And I still got a valuation that's much higher than what the price is at currently, which further just indicates that the stock is undervalued right now. But I do like to compare, my analysis with what professional analysts come up with. And when I do these articles, I use Morningstar and CFRA. And CFRA used to be S&P Capital IQ. They were bought out, so it's now CFRA. But it's the same reports. They look the same. They work the same. They have they provide the same information. So what I like to do is I like to say, okay, this is my perspective. This is what I think the company's worth. This is what I think the stock is worth. I'm kind of putting everything together, and I come up with this perspective, this analysis, this valuation. But where am I sitting relative to what some professionals that follow this industry and these stocks all day long professionally, they get paid to do this. Where are they coming up with? And so the first one I look at is Morningstar. And this is Morningstar's report on CVS. And we can see right here the fair value estimate right here of 109, right? So that's what I reflected in the article. I've got them at 109. And the star rating, they have a star rating of 1 through 5, with 3 being a fairly valued stock, 4 being undervalued, 5 being significantly undervalued, and then vice versa on with a 2 and a 1 star. And they rated basically 4 stars, which would indicate moderate undervaluation, which certainly if they think the stock is worth well over 100 a share, 109 a share, and it's currently priced at 77, I would say definitely moderately undervalued, probably getting pretty close to significantly undervalued. And then the other one I use again is CFRA. And CFRA is interesting. Sometimes I'll do these articles, and I probably started writing this article maybe in late June. I start writing the article 4 to 5 days before I even send it off for publication, and then it takes a couple days for it to be published. So it's sometimes a week or even 2 weeks of delay between when I start writing things and when the article is published. And then I'm doing this video then even sometimes a couple weeks or a few weeks after the article is published. So there's sometimes like a month or so of lag between when I got the information and when I'm doing these videos. And CFRA, they sometimes go through and they change these numbers a little bit, the fair value calculation. When I wrote the article, their fair value calculation was 108.80, which is actually right next to where Morningstar came in. And since I wrote that, and since I looked at that, they came down a little bit. Their fair value calculation right here is 95.80. So, they're actually closer to what I came up with. They're actually 2 pennies away from what I came up with. So it's interesting. Before they were 20 cents away from what Morningstar came up with, and now they're 2 cents away from what I came up with. So, I don't know. Maybe they read my article and came down to where I am. I don't know. I would argue that Morningstar is probably being a little aggressive, 109 there. I came up with a fair value a little closer to that last time I looked at CVS, but like I said, I backed that down just a little bit because of just a slight deterioration in the business, and I like to err on the conservative side of things when I do these valuations, because I'm really looking out over the long haul. So the last thing I want to do is be too aggressive, and then you have to start backing up 3 or 4 years into an investment. That's really not where you want to be. But I'll re-average these out. When I did the average here, 104.53, this was using the 3 numbers. This was using 108.80, 109, and the number I came up with, which is 95.78. I took those 3 numbers and averaged them out, which gave me a fair value of 104.53, which indicated that at the time of writing the article, the stock was 30% undervalued. But I'm gonna use the updated numbers since we're doing this video with you guys. So we got 95.78, we got 109. And we've got 95.80, right? So we've got a fair value of just over 100 a share, 119 cents. Okay? So if we take a look at where CVS is at now, back out the price, divided by the price, it's 29% undervalued. So it's pretty similar. And I think what happened there was, first of all, it's using 3 numbers. So, my number came way down anyway off the original average. And then second of all, the stock has dropped just a little bit from where it was before. It was at $80, I think, at the time of publication, which might have actually been a little higher than when I originally wrote the article. And now it's at $77.45, so it's a few bucks off. So it's, pretty similar. So in the end, the stock still looks about the same, about 30% undervalued. And if you wanted to be, if you wanted to be even more conservative with it, and want a bigger margin of safety, you could certainly do that. And be patient with it and wait for it to fall. The 52-week, if we look at the 52-week, 69.30 is the low. So, there could be some wiggle room there on where it was before and maybe drop back down to that. But if you're a long-term investor, boy, it's really tough to not like CVS here. Again, assuming that the entire business model isn't going to be negatively impacted by the move to e-commerce, with my personal opinion being that the retail side faces more risk than the pharmaceutical side, which actually is really worse because the pharmaceutical side is where most of the profit comes from. So, it's just something to think about there. So in the end, I've got the bottom line here. We've got a stock that's yielding, over 100 basis points higher than its 5-year average, 30% upside, and that's on top of whatever upside would naturally occur as CVS becomes worth more and as the stock value increases and as that price starts to, bump up against that over time. And we've got 14 years of dividend growth. We've got definitely potential for continued double-digit dividend growth moving forward, at least over the next 5 to 10 years. Again, maybe flattening out a little bit over time, but I think my 7.5% estimate going forward is, on the conservative side. Even if they flatten out that dividend, over 20 or 30 years and they start to come down in the mid-single digits, I think the average will hold, and I think that's a pretty good number to look at. So that's where we're at with CVS, guys. I hope you enjoyed the video. I hope you enjoyed the article. I hope this maybe cleared up a few things, and I look forward to doing these videos and talking about some things and kind of going back through my analysis and looking at it and showing where everything came from. I hope it provides a ton of value. I hope the videos and the articles provide value on undervalued stocks. And I really just appreciate the opportunity to talk with you guys and provide some, in-person analysis on this and the opportunity to actually go back through the words and the numbers and put a voice behind the ideas is really wonderful, and I appreciate it. So I hope you enjoyed the video. I'll see you next time. Thanks, guys. Bye-bye.